you mentioned 2011, Bitcoin running from 3 to 32. Did you stack up or not?
I bought my first Bitcoin at around $18 and I sold them at about.
Darren Camas is the co-founder and CEO of IPOR Labs. He's been building in crypto since 2011, from advising Cardano to launching one of the first global crypto exchanges. 4 years back, actually, I stumbled upon DeFi. I looked up what you're building. It's absolutely fascinating. What was that made you think there is a need for such a reference rate in DeFi?
I have probably more mistakes than successes, but if I didn't make those mistakes, I probably wouldn't be in the industry. I probably wouldn't be building what I'm building today. And, I take them as learning opportunities. I think that anyone who tells you that they have a 100% hit rate is absolutely a liar and is trying to sell you something that you probably shouldn't be buying.
Darren, welcome to Alpha and Ash.
Thank you, Sri. Thank you for having me.
You're just a little bit younger than Bitcoin in your crypto life. I understand you've been there since 14 years. So how did that come about? How did you end up in crypto 14 years back when Bitcoin was all of 2 years old? So let's start with that.
Well, I think it's all about being in the right place at the right time, or the wrong place at the wrong time, however you want to look at it. At that time, I'm originally from the U.S. I was living
Hmm.
in Chile at that time. I started my career actually right in the heart of the financial crisis. So I was living in Chile because I wanted to get some different opportunities. The U.S. market wasn't looking so great. I moved down and I met this group of expats at a barbecue, and they started talking about Bitcoin. And I said, what's Bitcoin? And they said, it's like this peer-to-peer crypto anarchy, like BitTorrent for money. And I had no idea what they were talking about, and I thought it was the worst explanation. And to be honest, for the past 14 years, I've been trying to come up with a better, easier, consumer-friendly explanation for Bitcoin. And actually, roundabout, I think that may be it. But that was, it was a group of guys that were very early on starting the first crypto exchange. It was called Trade Hill, and there were very few people in the world that knew about Bitcoin. I think maybe about 10,000 people across the internet. So we started in June of 2011. At that time, Bitcoin ran from $3 to $32 and back down to two and a half. Um, it was kind of my induction into financial markets. It was my obviously induction into cryptocurrency, um, and also into financial risk management and different types of risk management, operational, market risk. Running the first exchanges. We were number two to Empty Gox back in the day. Number three was an exchange called Verwox, and that was people trading Second Life Linden dollars for Bitcoin. So there was another virtual currency trading for the first virtual currency. It was kind of a crazy time, and to be honest, like there were very few. There was very little documentation or resources at that time. And the thing that most fascinated me was actually the very simple kind of difficulty adjustment of the Bitcoin mining mechanism, where every 2 weeks the hash rate goes up or down. I thought this was super cool. No matter what happens, there's always some economic incentive to secure the network, and that was kind of my induction into Bitcoin. And again, met the right group of folks at a barbecue, and I've been building ever since.
All right, and so you mentioned 2011, Bitcoin running from 3 to 32. Did you stack up or not?
I bought my first Bitcoin at around $18, and I sold
Mm-hmm.
them at about six and a half. And I actually wrote them down in the dip, and I only lost half because of some trading. And yeah, basically at that time when we shut down, there was no venture capital in crypto.
Mm.
There were very little utility for Bitcoin. I needed the float to run another business, and the only other place was really that I could use or exchange Bitcoin, if I needed to for operational cash, was Gox, and I didn't trust them at that time. And that was the right thing, but it was let's call it 2 years too early. One of the reasons we knew that because if you guys have ever heard of BitInstant was started as an arbitrage tool between Gox and TradeHill. And so we knew that there was a hole in Gox. We didn't know how big, but there were all of the signs. And so, I didn't feel comfortable parking my Bitcoin there, and built other businesses in the time. But yeah, so first was at a loss, and didn't start stacking then, but have at other points. And there's when you take risks, when you build, there's always opportunity costs. There's always risks. There's always decisions that you would make differently,
Hmm.
but also that's part of your journey. So, I have probably more mistakes than successes, but if I didn't make those mistakes, I probably wouldn't be in the industry. I probably wouldn't be building what I'm building today. And I take them as learning opportunities. I think that anyone who
Ye-
tells you that they have 100% hit rate is absolutely a liar and is trying to sell you something that you probably shouldn't be buying. So,
Hmm.
this is like the bit honesty. Yeah, that was
Right.
the early days, and then we did a bunch of stuff in between, and that's led
Hmm.
us to now, and now building deep in DeFi.
Right. Okay. Now we're gonna get there. And you spoke about sort of destiny being there at the right place, right time, and the financial crisis. I mean, those are all such important vectors that have to crisscross each other at the right sort of moment in time. So in my case, almost at the same time, 2000, I used to do mergers and acquisitions in London then, and
Hmm.
this is my third life, so that used to be my first life. And just before the GFC, the global financial crisis, unfolded, I was already planning to get back to India to found a consumer food company with a whole ethical supply chain built on technology, and to solve trust deficit between consumers and food, with and at around that time, and the financial crisis just blew up, and somehow I was so committed to the idea already. Um, I quit my job and went back to India, to not realizing the full impact of the crisis, that liquidity and everything will be completely sucked dry, everything. So it took me like 2 years to raise my first round of capital back then. But yeah, building. I got this lesson about building during crisis and downturns, how that can actually make you much more stronger and give you a very different perspective as well. So in a very different context, my time and place was went took me in a very different route at that point in time. But then whatever destiny has in store, and if it rings true with your philosophy, then you're back in. So 4 years back actually, I stumbled upon DeFi, and then I found it such a real foundational technology. And I was kind of already moving, exiting my first startup, which was my second life actually. And then I realized, wow, here's this opportunity to fix trust deficit in finance, from fixing trust deficit in food. And I find sort of every time you scratch the surface of DeFi and go deeper into what people are building, it's absolutely fascinating. And I looked up what you're building, Darren, almost like a reference in interest rate, like LIBOR used to exist earlier, and now more of SOFR. Um, Tell us about IPOR. What's been the whole thinking around that, and why did you? I mean, you've had this long sort of time in the whole crypto digital asset space, seeing DeFi being born, and what was that made you think that there is a need for such a reference rate in DeFi?
First of all, the thing that you mentioned was the idea of trust, right? And the thing about DeFi and the thing about crypto, one of the kind of the core ethos, if you're like a hardcore Bitcoiner, is like don't trust, verify. And the whole purpose of the network, this Byzantine general's problem, is that you don't have to trust any node in the network because it makes corruption very inconvenient or infeasible, right? So the whole idea of trust is that actually you shouldn't have to trust. You shouldn't have to trust counterparties. You shouldn't have to trust, when this asset is sent from point A to point B. There's always going to be some trust assumptions. Like, for example, if you issue an asset, on the like, for example, if you're wrapping an RWA, there's always the primary issuer risk. But the whole idea is actually minimizing the trust that you have to have in a system. And so that's a really nice kind of ethos to have in an industry, and especially
Mm.
financial services. So if I take this kind of like long roundabout from the first crypto exchange to now,
Mm.
actually, what did I needed the capital for was, my business partner was starting a risk recruitment firm, and we were recruiting financial risk managers. At this point, I was living in Chile. There was a financial crisis in Europe and Spain, and we were trying to get risk managers for very high level banking positions, and this was going further down kind of the risk manager's path. And it was also around this time in 2013 that the LIBOR scandal broke. So LIBOR, it was formerly the most important number in finance.
Yeah.
What is the LIBOR? LIBOR, London Interbank Offered Rate. It's
Mm.
basically a rate that is typically a premium to the the central bank rate, and it's literally a subset of banks talking with one another and saying, if I were to lend to you, this is
Mm.
the rate that I would lend to you at. So that is a survey-based approach. It connects, a certain number of London banks, and they say, okay,
Mm.
so this is the rate at which you can borrow
Mm.
for different assets or currencies across different tenors. And so that is insanely important because it gives us a standard rate, and that rate was used to fix something like 300 trillion worth of deals, debt, and derivatives
Mm.
used and basically pegged to the LIBOR. Uh, so if we go back to the idea of trust, trust was actually fundamentally broken in the LIBOR. So the LIBOR is insanely important because it gives you a standardized way of looking at cost of capital,
Mm.
and you have a bunch of instruments that are basically structured off of the LIBOR rates, or were structured. Except bankers were literally writing each other messages over Facebook, say, "Hey, Sri, can you add or shave off 1 basis point?
Mm.
I'll take the other side of that trade. I'll pocket
Mm.
the cash, and we'll walk off to the bank, and no harm, no foul."
Mm.
And this was happening when the story broke. It had been happening for probably about 2 decades, right? So at
Mm.
least since the '90s and probably before. So you have this trusted benchmark, which is being
Mm.
manipulated by untrustworthy bankers for personal gain. But it doesn't mean that a benchmark rate is wrong. A benchmark rate is fundamental. It's the trust assumption that's the issue. So that has really been taken over by the SOFR. And that tells us that still this idea of a reference rate or the risk free rate
Mm.
is absolutely important for the formation of capital markets, especially along the interest rates.
Mm.
Um, just what's we get rid of the corruption aspect. So in DeFi, we have a much more transparent aspect.
But
We
it
have
still wasn't risk free, right? There was the still a bank risk attached to the LIBOR
this
as well,
is
right?
it was termed as the risk free rate, right? So
Mm-hmm.
as as risk free as you can get. So risk when you say risk free,
Mm.
you always take it with a grain of salt, but it's determined of the risk free rate.
Right. And since we're in this, I mean, just for a better understanding, and then the SOFR came about, and
Mhm.
how did it address various issues? I mean, if you could just shed some light on that, your understanding of that.
Yeah, so far is a secured overnight financing rate. So it's basically more of like your repo rate.
Mm.
It's much more kind of like kind of real time.
Mm.
If you're going to lend to me, overnight,
Overnight. Mm.
how much would you charge? Right. So it's a different beast. It's more market weighted. Whereas the SOFR, it has some market weighting, but it's more of a survey approach. You choose a subset of banks, you take off the high value, you take off the low value, and you average them. Um, and actually, so since leading up to the formation of the IPOR protocol, Actually, it was about 7 years after. It was like around probably October, November of 2020. I was reading, kind of about the finally the unwinding of the LIBOR. And you think about the 7 years later, where it was supposed to be unwound in 2021, then it got extended to 2022. The issue is you had all of these long dated instruments pegged to the LIBOR. So it's not
Mm-hmm.
like you can just exchange the benchmark. It's not like you actually have to unwind those instruments, over the duration. And this is why you can't just switch from one benchmark to another, right? It's a
Mm-hmm.
different standard. It's a different beast. And you had all of these different. You had the Euribor, you had the Ameribor, you had different benchmark rates, kind of vying for the crown. And I was reading about this, and I was thinking, like, they were, the articles were pushing all of the risk around this. First on running in the LIBOR, and then distributing all of the instruments around multiple indices. That means that you get market fragmentation, you get liquidity fragmentation, you get volatility risk. So all of the kind of issues that come. So it's actually much better to aggregate all of the deal volume and the derivatives around a single rate, right? And that's effectively the SOFR now. So
Mm-hmm.
it's not really easy to go from one benchmark to another, and it's also risky to basically fragment capital across multiple benchmarks, because then it becomes less useful. The more volatile, the less liquid the markets are, the more volatility that you have. So we take this concept and we say that a benchmark rate is vital. It's best to aggregate around a single benchmark, and that becomes useful because it's useful for structuring. So, for example, the IPOR index is printed on chain as a public good, and
Mm-hmm.
anyone can use it to set their deal terms. So, similar to the LIBOR, we look at the IPOR as something transparent. We look at it as different, as survey based, where, for
Mm-hmm.
example, right now the IPOR construction is a market weighted mid market rate between the borrow and lend between Aave and Compound V3s on Ethereum
Mm-hmm.
mainnet, because those are the most liquid and they have different kind of characteristics, right?
Mm.
But it's also market weighted because it's weighted on the volume, and so that's a bit of a mid market rate. So it's neither the lending rate, it's neither the borrow rate, but it goes very well in tandem with the overall rate dynamic. Though there
Mm.
are there's basis risk if you're trying to hedge.
And this is all different for for the top stables.
Yes, yes. So we think that each stable has its own rate dynamics. So, for
Mm-hmm.
example, there's an IPOR rate for USDT, USDC, and DAI currently. And we also have an IPOR rate, which is not really an IPOR rate, it's the Lido ST ETH rate. And that becomes a tradable commodity now. So you have different benchmarks that are printed on chain. Any external protocol builder can use that to set their debt terms. And actually, the first instrument that uses that is the IPOR interest rate swap. And so, if we look at that, once again, we go back to the benchmark. Say a benchmark's nice, but it's a bit useless if no one's building on it. So the
Mm.
IPOR interest rate swap is trying to replicate what's a massive market. So, if
Mm.
we look at TradFi, Forex is king, and number two are interest rate derivatives, coming in at about
Mm-hmm.
600 trillion notional annual. And this is the largest market that nobody knows about, or very few people know about. Lack of interest rate hedging led to the undoing of Silicon Valley Bank, of Silvergate Bank. It almost bankrupted the UK pension system back, I think, in 2021. And right now, interest rate dynamics are going crazy with this kind of tariff war. You have both the short and the long ends of the curve with massive volatility. And so interest rates are, I would say, one of the world's most important markets. And in DeFi, most people care about derivatives speculating on assets, but it doesn't really add to any utility. So my view is that DeFi will be financial rails of the future. And in the case that it is, that means someday you're going to be able to go to DeFi protocol and be able to take a home loan. You're going to take a 30-year fixed rate mortgage from
Okay.
a DeFi protocol.
Hmm.
And that is going to be based on a reference rate. It's going to have one or multiple interest rate derivatives underpinning it.
Hmm.
But that whole process is going to be basically under the hood from a one click product for the end consumer. End consumer doesn't need to know what's going on. And I'm guessing that your average fixed rate mortgage taker is not reading the fine print or knows what's underpinning, but they
Hmm.
have a benchmark rate and they have interest rate derivatives underpinning their mortgage. And so that's kind of the short and long term view. I think it's a very fast, very high level overview, but kind of that's the goal of the protocol.
As you know, more and more what real world applications like home loans and stuff move on chain, and as you know, DeFi is designed to be the sort of financial rails. A benchmark rate will be used to underpin multiple direct debt applications, for example, and at the same time there will be a whole bunch of derivative applications like rate swaps, for example. Is there currently also is there an interest rate swap market in DeFi?
I would say that the interest rate swap market is quite nascent.
Mm-hmm.
And to be honest, it hasn't had a lot of uptake because people are very short term thinking. Most people are looking for speculation on assets and not really looking at their loan terms. For example, for if you're thinking about the average DeFi ape, they don't care about their interest rate going from 5% to 30% in a day. They're actually
Mm-hmm.
looking for asset appreciation of 5 to 30% in a day. So it's a little bit of a different beast, but it's insanely useful. So, for example, if you see like some of the main DeFi uh, let's call them yield farming or activities are leverage looping. And leverage
Yeah.
looping is borrowing one asset,
Mm.
getting access to another that has some yield bearing aspect, and
Yeah.
you're farming the basis on leverage. But if both of those rates are variable, you don't have a very nice structured product or a fixed rate of return. If you embed interest rate swaps in both of them, then you can have a nice one-click product. So I would say, most people are familiar with Pendle, and when they talk about IPOR, they say, "Oh, you guys
Mm.
are like Pendle, or Pendle's like IPOR," and these are actually fundamentally different markets, and they both exist, and they can both really coexist. So, for example, I would say that Pendle is much more of like a bond coupon market, right?
Mm-hmm.
It strips out the yield, and then you have that yield that you can trade until the expiry of the contract. Whereas IPOR is much more of a vanilla interest rate swap, and these both play well if you're doing something like like a relative value fund, or if you're doing interest rate arbitrage. And so all of these kind of rate markets, you have the money market rates, you have the fixed income rates, you have the bond coupon, you have the interest rate swaps. These all exist in TradFi, and
Mm.
they're starting to get picked up in DeFi. So I think now is a great time because the market is sobering up a little bit to the
Mm.
to the asset market, but a lot of people are looking to get yield on their assets, and getting yield means actually a lot of exposure to the credit markets, and the credit markets and the derivatives interest rates go hand in hand.
Sort of taking this point further on, the application of interest rate swaps in DeFi. Uh, just trying to understand. I mean, a lot of the DeFi loans obviously are very short term, and they are actually, like you said, used for leverage looping and stuff like that as well. Uh, what's the general sort of, what is the sort of median of the tenor of TradFi interest rate swaps? What are those loans generally? If you were to, they would all, I would tend to think, would be longer term in nature. That's why parties get into and swapping them in the first place, to because their sort of requirements of cash flows and interest payouts have evolved over time, and of course to hedge risk as well. So how, a, is that a correct way of looking at it? B, if that's the case, how would that change in DeFi?
Yeah, so I mean, in TradFi, yes, the interest rate swaps are very long duration. We're talking multi-year tenors, and if you're looking at some
Yeah.
of your most important points on the curve, the 2-year point and the 10-year point.
Mm-hmm.
And these don't exist in DeFi, right? DeFi, you don't have a 10-year point because you don't have 10 years even of DeFi, and the yield curve in DeFi is always inverting, it's always changing, it's highly volatile, especially on the front end. You have to put kind of a backwards lens. So if you're looking in TradFi, you're looking at like kind of 10 years, back to the present day. If you're looking in
Mm-hmm.
DeFi, we have to bootstrap that yield curve to get there. So we start with the idea of the IPOR rate as kind of your spot rate. And then we're bootstrapping this yield curve with the swap market, which is giving you the 1, 2, and 3 month points. So we're really looking kind of like to extend this yield curve 1 month at a time and into the future. So it requires, like, if you're coming from TradFi, you actually at the beginning, one of my good friends he's been a rates trader for the past 10 years.
Mm-hmm.
He was helping us out, and he's like, I couldn't do my job without without a these different futures, forwards, and swap markets that are highly liquid, and all these different data. I said, well, welcome to DeFi, where the lack of data points is your opportunity, but it's also crazy to price. So really, we took on, I would say, what's a crazy, like we tried to swallow the whale in one bite
Mm-hmm.
to basically be able to bootstrap the yield curve and an interest rate derivative market and price the volatility that you find in interest rates in DeFi in one go. And
Mm-hmm.
by and large, we did it and are still doing it. And it's a very early thing, but now the market is getting a little more mature.
Mm-hmm.
You have more sophisticated players coming in, but still, you're going to have to package a lot of these swaps into one-click structured products.
In DeFi, DeFi yields, everybody gets excited with multiple layers of yields, and then you collateralize one asset and get a loan on that, borrow against that, and use that for another yield opportunity as such. So apart from liquid staking, you also get collateralized loans. So once you bunch all of that, and like you said, sort of if you've got too many imbalances in your your interest payout profiles, then you could find a very interesting use case for a structured product there, right?
This is something that we're also tackling. So,
Mm,
for example, if we look at the IPOR rates, it's very futuristic thinking. Not just because of what it is, but also because it's something that assumes market maturity.
mm-hmm,
And what we get in DeFi is we actually have the market went from being actually more concentrated with just Aave and Compound to being more fragmented.
mm,
So now, even in those DeFi credit markets, we have Aave, Compound, we have Fluid, which is up and coming, we have Morpho, which is a beast, we have Euler, which just crossed 1 billion in deposits. You have all kinds of different credit markets. And actually, this is really amazing, but it's really bad from a hedging perspective because, going to that same kind of market dynamics that I was analyzing, in the unwinding of the LIBOR and, all of these different benchmark rates, actually, this liquidity fragmentation, it works out probably worse for borrowers and lenders in DeFi across the board. However, that's also another opportunity. So in building the IPOR protocol, we wanted to upgrade two parts. So for example, in the peer-to-pool interest rate swap, there's assets that go on the balance sheet. So if we take like USDC, depositor comes in, that's underwriting a portfolio of derivatives, both pay and receive fixed across multiple tenors. And then that's also getting plugged into an asset manager. So that was first going to Aave and Compound, but it was pretty stagnant. Uh, One of the issues for those, every time that you have to change those routes, you have to upgrade the smart contract and you have to touch the vault storage. So that, from a security standpoint, from a time to market standpoint, it's quite a pain. So we wanted to upgrade this asset management component and say, okay, we will go from Aave V2 and Compound V2 to the V3s. let's say we want to add in Morpho and Euler and Fluid and all these different markets. How can we do it kind of seamlessly? How can we keep the integrity of the vault contract or of the AMM contract, but how could we change the routes and basically make it modular and automatable? And we also wanted to create like this one-click structured product suite.
Mm. Mm.
And so we went into a couple of the processes that we went through in building the IPOR protocol. So V1, we had a very hard coded construction, where you have to add one route at a time. V2, we use something much more modular called the Diamond Proxy to route throughout the entire infrastructure. And that actually led to the design of Fusion, which is what we call now a polymorphic asset management protocol. Polymorphic in the fact that you can take a vault, a 4626 vault, you can add and change the routes without touching the internal storage and without upgrading the vault smart contract. So this is both secure, and I would say it's a 0 to 1 innovation in DeFi. And so Fusion is actually this one-click structured product stack. So, for example, you mentioned about like the rehypothecation of assets and routing them through different protocols. So if we look at like kind of vault protocols, like if we look at Yearn V1, you had very much the same. Well, we had the very much the same issues as Yearn V1. You build out a new connector, you have to remove a connector, you have to build, you have to upgrade, and the moving of assets is quite kind of manual. And if
Mm.
you look on like the other side of something like a Veda or a Sommelier, it's a very high trust barrier because you have calls that are coming from off chain. They're going through some side chain validation, but it's unbounded, and so it's a very high trust barrier. And again, I like to go back to the don't trust, verify. So in
Mm.
Fusion, the whole idea is that you can add or remove a root as simply
Mhm.
as adding or removing a fuse from an engine, right? And that's made possible by the Vault architecture, which is designed by our smart contract engineers. I would say some of the best in DeFi, mathematicians by background. One's a PhD, and he mentions that the other was always the better one in the class. And
Mhm.
really looking at like what's all cutting edge in DeFi and what can we adopt, but how can we innovate? So this whole idea of fusion is actually how we can do this kind of one-click structured products that you mentioned, which is take debt from here, deploy it here. Let's say even against that collateral that you deposit, you can borrow another asset and get access here and do a rates arbitrage while
Yeah.
actually farming optimally. So all of these strategies are we have different people building them right now on Fusion,
Mm.
and then it all ties back together. So in the structured product suite, now we have in design the interest rate swaps, not only for the IPOR indices, but also for the IBT or the interest bearing token of a single market. And that
Mhm.
means that these will also be kind of one click structured products where you can do these kind of leverage looping across different structured products. There's this USDC optimizer, which is going and getting I would say, the best of the low risk yield across Aave, Compound, Morpho, Fluid, Gearbox. And it's just doing the optimized allocation. And
Yeah.
you hook an interest rate swap up to that particular interest bearing token, and you now
Yeah.
have your most liquid, basically fixed income deposit. So
Mm.
all of these pieces you can kind of put together. And
Yeah.
we also have people on this optimizer that are building on top of that. So, for
Mm.
example, we have some of the Uniswap V4 teams that are building, as part of their hooks, they're building them into the optimizer. So, for example, you have someone with a DEX LP that's, let's say, USDC, USDT. You have
Mm.
multiple ticks, and when that tick is basically, when it's out of range, they drop those assets into the optimizer, and when it gets
Mhm.
back in range, they put it back. So this whole kind of composability and the money Legos, before it was a narrative, and now it's becoming more and more real. So this is something quite interesting. We have yield bearing stable coins and different banking products that are building on top of the optimizers. So yeah, I mean, this is quite exciting.
Yeah, no, absolutely. As you know, my the wheels in my head are kind of going round as you're speaking and as we're talking about this. We we're just in the process of deploying a triple staking product, completely one click. Okay, and you're essentially generating a yield on a stable, and there are multiple layers of staking in that product, all on top end protocols, and a user does that in a completely abstracted way. All they do is interact with one structure product, one vault, and deploy USDC, and everything is happening through the vault. And we face, you mentioned 2 points which for any builder would be very interesting, and we face it. We've been facing it as well. Every time we have to upgrade or integrate another protocol or a pool, which becomes easier if the protocol is already integrated. So, but you still have to deploy another vault for that. And something like Fusion, if that can kind of you can do it on the fly, that just makes it so much more better to create, to upgrade these structured products, keep them much more flexible in the way they can be designed whilst not compromising security at all. And of course there's a great overlap that could happen for these one click structured products to actually hedge the interest rates in that case. I mean, if one in our case at Arna protocol, we're also looking at building a collateralized loan platform where our, as we have these different structured products which are what we call ATVs. For example, our Arna tokenized vault 802 is an AI quant structured product. ATV 111 is a dual layer yield product. Now these ATVs could be collateralized, and up to a certain LTV you get a USDC loan. Now those loans can be very efficiently hedged in that sense when the collateralization platform talks to your protocol as well. I'm just thinking through how this could all make it much the one click approach can really do a lot more than what we currently are envisaging as a one click structured product.
Yeah, I think so. I think so. And we already have some people that are coming to us with these needs. And also, you can think of the vault itself as as a product, and you can rehypothecate against those assets.
Mm,
So, for example, one of the main strategies that's coming in the pipeline right now, if the market's going sideways or down, people want to earn, but they want to earn
mm,
against stables, right? So we have a lot
yeah.
of people that are coming and building leveraged stablecoin products, which is you're forming the basis between the cost of borrowing of, let's say, USDC and the yield bearing asset. So, for example, even the IPOR USDC Fusion Vault, the lending optimizers, they're yield bearing assets. You could build the same kind of product on that. You could build like a siloed Morpho or Euler pool.
Mm,
Get that listed as collateral and lever it up. The thing about Fusion is, you mentioned about the kind of the security and changing paths, and I was talking about the paradigm between where you have the hard coded roots or you have the trust me roots.
mm,
We want to go right in the middle where you have this trustless nature. For
mm,
example, at the vault, when you connect a fuse, that means that, okay, so let's say that you are creating the strategy. You're what we call the atomist. You're finding out the atomic nature of this yield strategy. And then we have what's called the alpha, which is the automator. They both can be you can get someone else to automate it. The whole idea
mm,
of this infrastructure is that you don't have to trust. So
mm,
you, as the atomist at the vault level, you can set assets, actions, and markets. So assets, at the vault level, you have a substrate that you can update with the different
mm,
assets. If that
mm,
asset isn't there, so for example, if you have USDC as an asset, only you can't that can't be swapped for another asset. You can't swap it for USDT. You
mm,
can't swap it for Doge.
mm,
So that's kind of security at the vault contract level. And this is something, again, transparency and trustlessness.
mm,
Then someone who wants to deposit into your vault can see which are the fuses that are connected, and they say, okay, so these are the roots. Assets can't flow from outside of these bounds. Again, transparency, trustlessness, but
mm,
also gating at smart contract level. And that means, for example, you can hire me as an alpha, I can
Mm,
execute a strategy. You can
mm,
give me the strategy. I can execute it on your behalf, but I can't go out of the bounds that you write at the smart contract level. That
mm,
protects kind of everyone in the value proposition from the depositors because they can see your strategy, you as the atomist from the alpha, and the alpha from everyone else because it has to work within these constraints. And that's actually a very nice mechanism, especially for AI agents, because AI agents, they have a huge amount of promise, but there's a huge amount of risk. For example, if I leave my wallet on the table, and it can go out and spin everywhere, maybe it will. But if I leave my wallet on the table and it's inside of a walled garden and there's these different stalls, then I know where it can be spent, right? So, for example, if you take this fusion vault construct and you create a kind of a walled playground, you know where the agent can spend, you know what actions it can do, and it can run around and go crazy within the playground, but it can't go outside. So this, I think, is an ideal kind of framework for agent-based asset management. So yeah, I mean, Fusion, it's really cool. Even what you mentioned about like um, having to upgrade the vault contract or deploy a new vault. One, it's a huge pain to deploy a new vault and say everyone move, right?
yeah.
And if you're an asset manager, you don't want the people to move. You want them to stay there because they get access to your strategies, which are changing
Yeah.
over time, but you
Yeah.
get access to the fee generation.
Mm,
So if you can change, let's say in this part of the cycle, you want to be momentum trading,
mm,
you can insert those fuses. Let's say
mm,
in this part of the cycle, you actually want to be leverage looping because you want to be short ETH. You can add those fuses to remove the others. Let's say this is the time where you want to do DEX LP. You can keep those in the same vault and you can
mm,
shift the vault strategy over time in the same vault without having to upgrade the vault smart contract,
mm,
without having to touch the storage. Again,
mm,
those are huge security concerns, and those are made possible. This kind of polymorphic vault is made possible by the fusion construction and the architecture.
all right.
And so, we wouldn't have designed it like this if we didn't make all the mistakes of building, first of all, a very rigid construct, and
Mm,
second of all, going to kind of a very using the diamond proxy, which is a router construct, and
mhm.
also looking at all of the vault architecture out there and picking a little bit, of the best of all things, and then actually innovating on top of that.
This is absolutely, um, very interesting stuff, and certainly I think we'll be having a chat um, after the podcast in the coming days, and I'm really looking forward to that. Can you tell me how you're building something which is deep and sort of fundamental, and these sort of things take time to build. The very idea of an IPOR in a benchmark rate in DeFi itself is forward looking. And how's your progress been? How when you are building something deep and foundational, quite often early product market fit, finding users, TVL, all of that becomes a challenge. So how are you balancing all of that stuff?
Yeah, I would say, maybe even one reason to cut the technical talk short is because we focus very much on deep financial primitives and very deep tech,
Mm,
and that gets lost on a lot of people. So, for example, the IPOR protocol is called IPOR protocol because it's a hat tip to the LIBOR. It's the
mm,
inter-protocol overblock rate. But in crypto, people say, "You poor bro," and it's very memeable and it's very hard to
mm,
understand. And that's actually been a big blocker. So
mm,
if you look at Fusion, actually, we will probably be changing the protocol's name to Fusion.
mhm,
Fusion because it's much easier to grasp. Fusion is like turning liquidity into energy, right?
mm,
And even like the fuse construct of adding and removing a fuse, it's much easier to understand. So
mm,
we focused a lot on building financial primitives and also calling it around the financial primitives because we thought the market would get mature faster than it
mm,
would. And actually, Fusion is a market maturity engine. If you
mm,
think of a simple optimizer, it just deploys capital where it's needed most.
mm,
Wherever you have the highest utilization, it drops it there.
So you're talking about sort of one is kind of the rebranding, the redefining the whole narrative for more sort of community engagement and stuff like that, right?
Think of it like driving a car, right?
Mm,
And this is how I've thought of crypto for many years. I remember having some conversation with some guys in like 2016 in Taipei, and we were having the same conversation. Crypto, we focus too much on talking about the deep tech.
mm,
Sometimes it's to cover over our own deficiencies, but in the end, the average person wants this one-click product. Like if you go to a car dealership, the car dealer is going to look at you and they say, they're not going to go into the alloy of the piping or the where the fabric is made on the
mm,
upholstery, or go into like the deep technicals around the they're going to tell you what color you can get it in and how fast it goes 0 to 60 or 0 to 100, and can you get it in red, right? So the whole idea of fusion, it's like selling the car, and IPOR infrastructure is somewhere deep down holding it together. It's this invisible part, but we're going with the car sale.
mm,
Fusion is the one click earn button of Web3.
mm, mm.
So it's actually this like deep, very technical infrastructure, but it makes all of that process, the integration, the automation, and the security simple.
Yes to all of that, and you and I, we can get lost in this very interesting conversation. But I want to kind of bring you as a builder, as a founder. How have you been addressing and crypto? It's actually the two ends of the spectrum. You've got those that are building a deep infrastructure or redefining an asset management stack, or,
Mhm.
stuff like that, and then your narrative has to be in a particular way. You can't make it degen, and then it and also the focus is on the product and build and the technology. And at the other
Yep.
end, there's a whole bunch of stuff which is kind of also overtaking the market, which is all narrative and hype. There is really no substance, or there's no product in that sense. There's a whole narrative loop which drives them. So I think there are both ends that sort of
Mhm.
exist, and both have to learn from each other. I think, what have your learnings been on, and how are you addressing these challenges since you've gone live with a product like yours?
Yeah, so we're taking the focus away from the primitives and we're putting it on Fusion, which is the one-click earn button of Web3, right? So your average person doesn't care about the recipe. They don't care about. They just want the simple progress. So literally, the whole branding around Fusion is abstracting all of the complex things and making them simple, but making them secure and giving the user the one click earn button. So literally that's it. And this is where we're actually doing right now we're scaling TVL around these
Hmm.
products. So
Okay.
for example, you go on the IPOR app, you see the asset, you see the APR, you see who's curating it, and
Hmm.
then you do one click and you're in. And so
Hmm.
this kind of one click magic is what we're seeking to deliver to the end user, with
Hmm.
all the
Okay.
all the complexity, all the risk management, all of the infrastructure in the back end,
Hmm.
that really it makes it simple for the average person to earn smart in DeFi.
You've had your TG also, was it sort of recently in the recent past, right?
It was January in 2023, so kind of right in the depths of the bear market and right after FTX collapsed.
Ah, okay, all right. So tough times. And what's the thinking around the utility of the protocol token?
Yeah, so by the time this podcast drops, it will be already announced. We have a plan to take the IPOR token private because we have a
Okay.
rebrand around Fusion, right? So
Mm-hmm.
Fusion, both Fusion and IPOR protocol, they have a lot of very core revenue generations that goes back to the DAO, and that can be used for a number of things, right? So think of Fusion as infrastructure for asset management, and the DAO earns basis points on the management and the performance, and then the people that build on top of it can set the rest. So Fusion takes a small cut of every asset managed through the protocol,
Hmm.
and that can go back to a couple of things. It can go back to protocol development, it can go back to buyback and burn, or it can go back to buyback and LP. And I think
Mm-hmm.
buyback and LP is probably the best thing because it adds some buy side pressure, but it also deepens liquidity in the markets over time, right? And so I think that's probably the number one use of Fusion, of the Fusion token.
And the Fusion token is already released
Fusion token, no. So the proposal is to take the IPOR token private
private.
and then
Okay.
relaunch as Fusion. It will migrate in a
Okay.
one-to-one conversion.
Mm-hmm.
But for example, there's some time right now. We have a bunch of asset managers that are coming through the
Mm-hmm.
pipeline. We'll get them online, build
Mm-hmm.
TVL, and then
Mm-hmm.
have kind of a rediscovery of Fusion in that way. It's a way to renew the brand, and it's
Mm-hmm.
also a way for basically turning people on to what they used to see as a very complex product, which is now a very simple one-click earn. So on one side, Fusion, it has this revenue generation from the asset management side, but actually,
Mm-hmm.
the asset management generation, the fee generation on the derivative protocol, which
Mm-hmm.
goes baked into these one-click products, is much
Mm-hmm.
higher because in
Okay.
those pools, actually, the
Mm-hmm.
DAO earns a much higher
Mm-hmm.
fee from the asset management,
Okay.
and it
And
also earns
mhm.
from derivatives,
All right.
which
Okay.
deepens the liquidity. It makes
Mm-hmm.
the instruments much more useful, and it also generates much more revenue to go to buyback and burn or buyback and LP. So think of it like two sides of a flywheel that
Hmm.
work one to another.
In this rebranding and relaunch of the protocol token, what's going to happen to the benchmark index? What is it going to be called then?
So the benchmark index, all of the assets of the IBOR protocol will be transferred to the Fusion DAO, Fusion protocol. This is governance willing,
Mm-hmm.
and go to the same revenue generation. So think of it as like one DAO that has two fully functional protocols, fully developed,
Mm-hmm.
with strong revenue generation that are going to the same DAO treasury.
Okay, so the benchmarks will continue to remain as a USDC
Correct.
IBOR or right?
So
Okay,
you can
all
see it
right.
as kind of two protocols. You have
Mm,
Fusion, and then you
mm.
have IPOR derivatives. IPOR
Okay,
derivatives will kind of take a
right.
backseat in the marketing, but
Yeah.
they'll absolutely remain. So I mean,
Mm,
they're a key revenue potential driver.
mm,
And again, they go baked into structured products. So this is
mhm.
like, I mean, they go hand in hand.
In the construction of the, let's take the USDC or USDT or DAI IPOR, is it only DeFi reference rates which are taken, or is it also
Yes.
CX? Hmm? Okay.
Only DeFi reference rates, actually, for the time being. So the IPOR rates is like anything that can be done on chain should be done on chain.
Mm-hmm.
So, DeFi credit markets, instead of having to trust a potentially corrupt banker, it just reads from the smart contracts. Those
Mm.
smart contracts
Yeah.
are immutable, they're transparent. And
Yeah.
so we feel that the IPOR index is it's a similar construct to what we get
Mm,
in traditional finance, but it's
mm.
much better. It's transparent, it's immutable, it's forever, and it's a very nice construct to build on. So these definitely won't go away.
And to that future, let's toast to that. Or is there anything specific you'd like to toast to, and what are you having?
I'm having my coffee, so cheers to that, and to a very fusion future, to one click magical earn in Web3.
Yes, to simplifying DeFi and really creating simplified structured products, which will, I always give this analogy about how in TradFi it's structured products which made adoption easier, scale much more easier. It's not individual underlying asset classes, but all structured products from the simplest of ETFs, indexes to mutual funds to more complex hedge funds, quant funds, and stuff like that. And that's exactly what we need to build on chain in crypto. So yes, to that future, and cheers, and to the your rebranding and relaunch as Fusion. Just for that.
Thank you very much. Cheers.